Imagine buying a car in 1977 and, almost as an afterthought, buying a few $1,000s of stock in the company that made it. Nothing dramatic, you just like the car. Fast forward 9 years, and that small, forgettable decision has turned into over $1 million. That's not a hypothetical. That's a real calculation Peter Lynch did in his own book, using Subaru, a company most Americans in the 70s thought of as a quirky, cheap import, not a life-changing investment. If you'd bought the stock at its low in 1977 and sold at its high in 1986, you'd have turned every $6,000 or $7,000 into roughly $1 million. And the wildest part isn't even the return. It's that nobody needed insider information to see it coming. You just needed to notice what was happening in your own driveway. Lynch had a word for a stock that does this, that goes up 10 times over from where you bought it. He called it a 10-bagger. And once you understand what it actually is, why it works, and why almost nobody holds onto one long enough to enjoy it, you'll never look at a boring, ordinary stock sitting in your portfolio the same way again. So let's start with the obvious question. Where does this word even come from? Because it sounds like something you'd hear in a casino, not on a Fidelity earnings call. Lynch borrowed the term from baseball. In baseball, when a runner advances, they touch a base, sometimes called a bag. A single gets you to 1 bag. A home run, if you want to stretch the metaphor, is worth 4. Lynch took that idea and applied it to stocks. A stock that doubles is a 2-bagger. A stock that triples is a 3-bagger. And a stock that increases in value tenfold, turning $10,000 into $100,000, is a 10-bagger. Coined it, popularized it, and by the time his book, One Up on Wall Street, hit shelves in 1988, the word had escaped the world of professional fund managers entirely and became part of the everyday vocabulary of anyone who's ever opened a brokerage app. But here's what makes this concept so much more interesting than just a cute nickname for a big win. Lynch wasn't describing luck. He was describing a strategy, and it's a strategy built on a piece of math that most investors never actually sit down and do. Because the normal instinct in investing is to think about your portfolio the way you think about a report card. You want every single stock to be a good grade. You want everything to go up, and if one position is down, that feels like a failure that needs to be fixed immediately. Lynch's entire philosophy rejects that framing. He openly admitted that in a portfolio of stocks, plenty of them are going to do nothing, or worse, lose money. And that's fine. That's expected. Because the math of a single 10-bagger is so lopsided in your favor that it can carry the weight of a dozen losers sitting right next to it. Picture 11 stocks in a portfolio, each with an equal amount of money invested. 10 of them go absolutely nowhere. Flat. Dead weight. But the 11th one, the one you almost didn't buy because it seemed too small or too boring to matter, turns into a 10-bagger. Do the math on that portfolio, and you're still sitting on a fantastic overall return, even though 90% of your picks did nothing at all. That's the entire secret hiding inside this word. You don't need to be right about everything. You need to be right about one thing, and you need to actually let it run. And Lynch didn't come up with this concept from a textbook. He lived it, starting with his very first stock purchase, years before he ever set foot inside Fidelity. While he was a college student at Boston College, funding his education in part through the same caddying job that had introduced him to investing in the first place, Lynch put together a small amount of savings and did something most 19-year-olds never bother to do. He researched an industry, specifically the air freight business, because he had a hunch that shipping goods by plane was going to become a much bigger deal than people realized. He found a small airline called Flying Tiger, bought shares at around $7 each, and largely forgot about it. Then the Vietnam War escalated. The military needed a way to move troops and supplies overseas quickly, and Flying Tiger became one of the companies handling that demand. The stock eventually climbed to around $80 a share. That's roughly an 11-fold return, a 10-bagger by his own definition, on the very first stock he ever owned. And Lynch has said more than once that the profits from that single position helped pay his way through his MBA at Wharton. So before he ever managed a single dollar of anyone else's money, before Magellan, before the 29% annual returns, before the books, Lynch had already lived the exact lesson he'd spend the rest of his career trying to teach other people. One good idea, backed by real research, can change everything, even if you're a college kid with barely enough money to make the bet in the first place. Now here's where a lot of people get this concept completely wrong, and it's worth pausing on because it's the single biggest misconception about 10 baggers. Most people assume a stock like this has to come from some obscure, high-risk, speculative company, a biotech nobody's heard of, a penny stock trading for pennies for a reason. Lynch spent a huge portion of his writing specifically pushing back against that assumption because in his experience, some of the best 10 baggers of his era came from companies that were sitting in plain sight the entire time. Dunkin' Donuts, Pep Boys, the auto parts chain, The Limited, a clothing retailer, Eleg's, the pantyhose brand his own wife discovered in a grocery store checkout line, which turned out to be one of the most successful consumer product launches of the decade. Taco Bell, which he noticed because his own kids couldn't stop talking about it. None of these were secret startups. They were businesses hiding in plain sight, expanding store by store, quietly compounding in value, while most of Wall Street was too busy analyzing complicated industries to bother looking at a fast food chain or a hosiery brand. Lynch's argument was almost insulting to the entire finance industry when you think about it. He believed a regular person, someone with zero access to institutional research, zero Bloomberg terminal, zero meetings with company executives, had a genuine structural advantage over most professional analysts simply because that regular person could notice a trend in real-life months or years before it ever showed up in a research report. So, if 10 baggers aren't hiding in some exotic corner of the market, where do they actually come from? Lynch's answer was refreshingly unglamorous. Start close to home. Not metaphorically. Literally. He meant your workplace, the mall you shop at, the restaurant that suddenly has a line out the door every time you drive past it, the product your kids won't stop asking for, the brand your spouse suddenly can't stop mentioning. The idea is that ordinary consumers, the people actually buying and using a product, are a leading indicator that shows up long before earnings reports, long before analyst upgrades, long before the stock becomes a headline. But, and this is the part people conveniently forget, when they only remember the invest in what you know bumper sticker version of Lynch, noticing the trend was never supposed to be the finish line. It was the starting gun. Lynch was explicit that liking a product gets you interested in a company, but it says nothing about whether the stock is actually a good investment. From there, you still have to check whether the company is actually growing its earnings, whether the balance sheet is healthy enough to survive a rough patch, whether the valuation still leaves room to grow, and whether the business has room to expand into new markets rather than being maxed out already. Skip that step, and you're not investing. You're just guessing with extra confidence. Let's go back to Subaru for a second, because it's the single best illustration Lynch ever gave of how big this can get when the fundamentals actually cooperate with the trend. In 1977, Subaru of America was still a fairly obscure Japanese import brand in the United States, nowhere near the mainstream household name it is today. The stock traded down around $2 a share at its low point that year. If you'd bought it there and held all the way to the high in 1986, accounting for an 8 for one stock split along the way, you'd have ended up with the equivalent of over $300 a share. Lynch actually ran the numbers on this in his book. A little over $6,000 invested at that low, right around what a new Subaru might have cost you at the dealership at the time, would have turned into approximately $1 million by the high in 1986. That's not a 10 bagger. That's what Lynch called a 156 bagger, a stock that went up over 150 times its original price. And he used this specific example deliberately because it makes a point that a lot of investors resist believing. The math on a 10 bagger sounds almost unbelievable until you actually run it. And once you understand it's mathematically possible from an ordinary, boring car company, it stops sounding like a fantasy and starts sounding like something worth actually paying attention to in your own daily life. But here's the uncomfortable twist in this story, the same twist that showed up when we talked about Magellan's own investors losing money while the fund itself returned nearly 30% a year. Finding a 10 bagger is actually the easier half of this entire equation. The harder half, the part that separates people who read about Lynch's philosophy from people who actually benefit from it, is holding on, because a stock does not travel from a 2 bagger to a 10 bagger in a straight line. It chops around. It has scary drawdowns along the way. It has quarters where the story looks broken, where a competitor announces something scary, where the entire sector gets hit by a wave of pessimism that has nothing to do with the specific company you own. And the natural human instinct, the instinct that governs almost everyone's portfolio decisions, is to sell the winners early to lock in a gain that feels good in the moment and hold on to the losers out of a stubborn hope they'll eventually come back. Lynch had a phrase for this exact behavior. He described it as pulling the flowers and watering the weeds, meaning investors instinctively cut their best performing positions short while stubbornly clinging to their worst ones, which is the precise opposite of what actually builds wealth over time. If you'd sold Subaru after it had merely doubled, which is exactly what most disciplined, risk-conscious investors are taught to do, you'd have missed roughly 98% of the total return that stock eventually delivered. So how do you actually apply any of this without turning into someone who just buys whatever product their teenager mentions at dinner and calls it a strategy? Lynch's own approach gives us a pretty clear checklist, even though he never phrased it quite this rigidly. Start with the observation: a real product or service you or people around you are genuinely excited about, not because an ad told you to be excited, but because you're seeing it show up organically in daily life. Then check whether the company behind it is actually still early in its growth story rather than already sitting in every mall in the country, because a 10-bagger needs genuine room left to run, not a company that's already saturated its market. Then look at the actual financials. Is revenue growing? Is the company profitable, or at least on a believable path to profitability? Is the balance sheet clean enough to survive a bad year without the whole thing collapsing? And finally, and this is the step almost everyone skips, decide in advance how you're going to behave once the stock starts moving, because the single biggest threat to your own 10-bagger isn't a bad quarter from the company. It's you panicking out of a perfectly good position the moment it gets uncomfortable, or the moment a headline makes you nervous, or the moment it's simply gone up so much that keeping it starts to feel greedy rather than disciplined. And that's really the entire lesson buried inside one simple baseball term. A 10-bagger was never really about luck, and it was never really about finding some secret stock nobody else has heard of. Some of the biggest ones in history came from a donut chain, a pantyhose brand, and a car company most people thought was a joke. The genuinely hard part was never spotting the trend. Lynch proved over and over across an entire career that ordinary people spot these trends constantly, usually well before Wall Street does. The hard part is doing the actual homework once you notice something, and then having the discipline to sit still while the position does exactly what it's supposed to do, which usually means making you deeply uncomfortable somewhere along the way. So the next time you notice a product, a restaurant, or a brand that seems to be quietly taking over your own life before it's taken over the headlines, don't just make a mental note and move on. That instinct, the one Lynch built an entire legendary career around, might be worth more than you think. And in the next video, we're going to dig into exactly how Lynch decided when a stock had officially become too popular, too expensive, or too late to buy, the other half of this equation that almost nobody talks about. So if you don't want to miss it, you know exactly what to do.